Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Monday.com. So Monday.com reported their Q4 results and we're going to go through that. So its guidance is quite promising, there's a lot to be compelled about right there. We're going to talk about the one blemish that's really weighing on the stock right now, and namely that's its path to profitability remains some time away. That's weighing on the stock. A lot of people are concerned about that, particularly right now. A lot of these high growth names have been hit severely. But ultimately, on a multiple to gross profits, so not on a multiple to sales, but on a multiple to gross profits, the business is priced at approximately 17 times this year's gross profits, which doesn't seem that expensive. So gonna go through and discuss that. So this is the thing that we've seen many times before already. So in the past 6 months, growth has popped and the stock is down for Monday.com approximately 55% year-over-year is in the past 6 months. Now, this is the thing, right? It's just become like one trade, right? So in 2020, it was all one trade. Everyone was like, if you're digitally enabled, poof, everything goes up. And then in 2022, if you are in any way showing either a slowing growth rate or your path to profitability some time away, it's all just become amalgamated, just become one trade, and everything just kind of a bang. It doesn't matter about the gross profile of the business, it doesn't matter so much about the gross margins of the business, it doesn't matter about operating margins. Like, it's just become like, just the market's become quite undiscerning, and I contend that if you're willing to do a little bit of work and your time horizon is a little bit longer than, let's say, 60 days, which apparently, like, everyone else seems to be looking at the next 30 days. So if your like time horizon is a tiny bit longer than that, I think that these are interesting investments. But you need to position yourself in a manner that you're not going to become too overwhelmed, and don't look to kind of buy the dip. A lot of people kind of like, very aggressively like want to kind of get in there. The market can remain really rational for so much longer than you can possibly imagine. Whatever you can possibly imagine, it can become irrational for a lot longer than that. So with all that in mind, I think it's worthwhile just kind of leaving yourself time. So don't kind of be too aggressive in buying in, and let time do its business. So it's a time in the stock, not about timing the stock. Okay, so I mean, like, the way I see it is, look, the guidance for this year is pointing to approximately 54% year-over-year growth rates, okay? Now, this is a management team that is consistently guided slightly lower and easily beat the consensus. So, they know what they're doing, okay? So, by all intents and purposes, it's going to come in, the revenues are just shy of $500 million in revenues. So this is a subscription business, and if they're able to kind of continue growing at this rate, I think that this is really, really compelling, okay? And I think that there's plenty of reasons that we're going to go through to unpick why, I suspect that these high revenue growth rates will continue to persist for some time. Okay, so a lot of people think about Monday.com, they say Asana, like it's like the first thing they say, Asana. It's like, it's not Asana, it's quite different from Asana. It does have some elements that kind of overlap the two businesses in terms of that collaborative structure. How Asana has the ability to really, for you to be able to measure and see the progress in the workflow. So it does have a bit of that, but it also it has some elements that are a bit closer to Workday and Atlassian too. So it is a bit more of a kind of a no-code platform. The way that Monday.com describes itself is that you shouldn't be having to force your customer to adopt your way of presenting the workflow. It should be able to be a workflow that has an infrastructure on the baseline, and you be able to use modular parts of the code that you want, either, for example, for marketing, for customer relations management, video, whatever you want. You should be able to use modular parts of it through its no-code building blocks. So I think that this is, something that is distinguishable about the business. It's also highlights during the recent quarter that it's made some few product highlights, content directory, audit logs, encryption, security. So there are a lot of aspects that they're rapidly expanding to increase the offering, particularly at the enterprise module. So it's one of those business models that, depending on how many number of seats you get a different tier structure. And particularly they're aiming very, very significantly to increase the value that they offer the enterprise customers. Okay, now this is something that I find particularly interesting, okay? So the number of customers adopting Monday.com was up 34% year over year to 152K as of December 2021, okay? But of larger customers, those that are spending more than 50K, they were up nearly 3x as of Q4 21. So the larger customers, those that are high quality customers, now make up approximately 74, let me just repeat that, 70, I think it's 72% of the total AIR, up from 63% in the same period a year ago. So again, the larger customers make up nearly just over 70% of the annual recurring revenues here. So this is a high quality customer. You know, it's a customer that if we go through an economic downturn and there's a kind of macro factors that people are kind of concerned about, you know, those high quality customers that have more spending power, that have more than 10 seats per enterprise, those are going to be able to withstand the vicissitudes of the market. And Monday.com is continuing to grow that at quite an aggressive rate. You can see here in the graph, it's up. They put 200% year over year. I mean, they're doing really well where it matters. Now, the one thing that everyone's kind of thinking about is this here, right? So Q4 21, the operating margins was negative 10%, meaningful improvement from the same period a year ago, okay? Because in the same period, in Q4 2020, it was negative 47%. This dropped to negative 10%. Wow, terrific, right? The problem is that the guidance for Q1 is pointing to approximately negative 44%. So everyone's like, okay, what's going on here? But you have to remember that on a year-over-year basis, the Q1 last year was negative 40%. So it's not all that different at negative 44% compared to negative 40% that it was in the same period a year ago. So there's sequential improvement throughout the year, but on a year-over-year basis, it's very much like for like. Now, everyone's kind of thinking themselves, okay, oh, I don't want to have this uncertainty. It's like everyone's kind of just looking out for the next 90 days, and it's become quite difficult as an investor to have a slightly longer time horizon. I mean, it's tough. Everyone talks about having a long time horizon, but nobody really has the stomach to go through it. It's one thing to say it in your mind, but as Buffett says, the distance between your mind and your stomach sometimes is really, really long. Now, as I see this right now, okay, so if we turn out and see that the business continues to improve throughout the year, I think that people will be very quick to come back in and think, okay, you know, let's look at this with a fresh pair of eyes. It's not really that it's burning a lot of cash. So it's, you know, as if you look in the previous 2 years, the non-GAAP operating gross margin, non-GAAP gross margin was 90%, okay? 88, 90%. Now let's make an assumption. Let's make the assumption that going into 2022, that the gross margins compressed to 87%, okay? So it's like coming back a little bit. So that would imply that gross profits will reach approximately 420 million in 2022. That puts the stock right now at prices 17 times this year's gross profits. For a business that's clearly growing, I mean, there's no question that this is growing. It's growing really, really fast. I don't think that paying 17 times this year's gross profits is that expensive. Of course, you got to caveat that, because you got to say, okay, listen, when it comes down to it, we're looking at a business that isn't really cutting out a clear path to profitability. And that's why I'm not investing in this right now. I'm going to see how this unfolds. Because I work quite hard, so I've got a lot of opportunities, and there's some names that I think that are really, really compelling, that are growing really fast and generating ample free cash flow right now. And they're not priced very expensively. Because if you work quite hard, you can be quite selective. But if you want to find out those names, don't forget to check out my marketplace. It's called Deep Value Returns. I help you by becoming a better investor. I give you these high quality, actionable investment ideas. And yeah, and I hope to see you soon. Check out what other people said on the platform. See you soon. Bye-bye.